Uber is currently printing cash at a scale that's honestly hard to comprehend. And yet, the market is pricing the stock like it's a dying company facing an absolute existential crisis. There is a massive tension right now between the financial reality of Uber's core business today and Wall Street's utter terror about what happens tomorrow when autonomous vehicles finally scale up.
So let's dive straight into this massive disconnect. Over the trailing 12 months, Uber just crossed $10 billion in free cash flow for the first time in its history. $10 billion. That gives the stock a free cash flow yield of roughly 7.2%. Now, for a technology platform that's compounding its bookings at over 20% and scaling EBITDA at over 30% annually, a 7.2% yield is shockingly cheap. It means the market is essentially treating Uber like a mature, low-growth utility company. Why? Because investors are terrified that the software developers building robotaxis are going to bypass Uber entirely. They're afraid Uber's massive network of human drivers is about to turn from an impenetrable moat into a massive liability.
But to really understand if the market's fear is justified, we first have to ground ourselves in the reality of Uber's economic engine today. Because this isn't just a ride-hailing app anymore. It's the preeminent global marketplace orchestrating the movement of people, consumables, and commercial freight across more than 70 countries.
Uber's actual business model breaks down into three core pillars. And it's crucial to remember they operate an asset-light technology platform. They don't own the cars. They just connect independent service providers with highly aggregated consumer demand. In mobility, which covers UberX and high-margin corporate travel via Uber for Business, they take a percentage cut of the passenger fare, which is now being heavily supplemented by in-trip advertising. Then you have delivery. This has expanded way past just restaurant food. We're talking about a $15 billion annualized run rate for grocery and retail, where they make money on merchant commissions, delivery fees, and really lucrative in-app ad bidding. And finally, in freight, they act as a digital brokerage, capturing the spread between what a shipper pays and what a carrier takes.
Here in the US, this economic engine operates as a highly lucrative duopoly. Uber holds roughly 74% of the US rideshare market, leaving Lyft with the remaining 26%. And that dominance isn't an accident. It's the result of brutal two-sided network effects. Higher driver density means lower wait times for passengers. More passengers mean higher utilization and better hourly earnings for drivers. It's a flywheel that is incredibly difficult for any new entrant to break.
But the real secret weapon, locking in that 74% market share, is their ecosystem advantage. Uber has over 50 million members in its Uber One subscription program. To put that into perspective, those members now account for more than 70% of all delivery gross bookings. Here's the really important part. When a user utilizes both mobility and delivery services, they generate roughly 3 times the gross bookings and profits compared to a single product user. This drastically lowers Uber's customer acquisition costs and gives them the data scale to optimize routing down to an average of just 33 minutes per delivery. That's outperforming competitors by about 5 to 7 minutes on average.
So, if the business is this dominant and the cash flow is this ridiculously strong, what could possibly derail it? Well, that brings us to the rapid commercialization of Level 4 autonomous vehicles.
This right here is the question keeping investors up at night. Uber's official strategy is to be a partnership-driven platform. They've committed over $10 billion to autonomous vehicle integrations, securing alliances with everyone from Waymo and Cruise to Lucid and Nuro. They want to be the central marketplace for the autonomous era. But what if the developers building these autonomous fleets decide they just don't need Uber? What if they build their own vertically integrated networks?
And this isn't just a theoretical threat anymore. In July 2026, reports surfaced highlighting this exact nightmare scenario. Waymo is exploring a split from Uber in Austin and Atlanta, and they're planning to launch their independent Waymo One app by June 2027, right ahead of their contract expiration. Waymo is backed by Alphabet's massive balance sheet, and they want total control over pricing, customer data, and branding. Uber just wants to treat autonomous vehicles as another standard category inside its horizontal app. If Waymo successfully scales an independent operation, Uber's ride-sharing moat suddenly looks incredibly vulnerable.
And by the way, if this kind of deep, research-first analysis is your thing, you'll probably want to subscribe.
So, with that existential threat hanging over the stock, let's look at the hard evidence from their Q2 earnings report on August 5, 2026, to see if the core business is actually showing cracks.
Let's break down the numbers. Gross bookings reached a staggering $58.02 billion. That's up 24% year over year, and it beat the high end of management's guidance. Non-GAAP earnings per share came in at 81 cents, up 35%, completely crushing analyst expectations. Free cash flow was massive, hitting $2.79 billion for the quarter. But, and there's always a but, Revenue came in at $14.19 billion, which technically missed analyst expectations by a tiny margin of 0.1%. This was mostly due to an accounting change in the UK where driver payments are now deducted directly from revenue. However, paired with a slightly cautious Q3 profit guide, this minor revenue miss was enough to send the stock dipping nearly 4% on earnings day. It just proves the market is so on edge about the AV threat that absolutely any slight imperfection gets heavily punished. But if you look under the hood, the operational leverage is actually improving rapidly. Operating margins for mobility expanded to a record 7.6% of bookings. Delivery operating margins jumped to a record 3.8%. This is being driven by improved operating leverage, incredibly high consumer retention, and scaling that high-margin advertising revenue. The underlying business is getting significantly more profitable, not less.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes, while Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's pull back from the quarterly numbers for a second. We need to synthesize the broader qualitative health of Uber's business to evaluate the actual long-term investment opportunity. Based on the research scorecard, the overall blended score for Uber comes in at a very strong 8.2 out of 10. A huge driver of this is a 9 out of 10 for management alignment. CEO Dara Khosrowshahi is heavily invested. He holds an estimated $500 to $700 million in stock, with 77% of his target equity at risk through performance units. He is incredibly aligned with shareholders. Market position is also a 9 out of 10, given that U.S. duopoly and their massive global reach. Capital allocation sits at an 8 out of 10. Management is smartly balancing a massive $20 billion share buyback authorization with strategic platform partnerships for the Robotaxi era. And speaking of capital allocation, we absolutely have to talk about the pending $14.8 billion voluntary public takeover offer for Delivery Hero, which was announced in July 2026. This is a massive strategic play. It expands Uber's operational reach from 79 up to 99 countries across Europe, Latin America, the Middle East, and Asia. Once this is completed, Delivery will represent 56% of Uber's pro forma gross bookings, positioning them as the undisputed premier delivery platform outside of China. It's a really bold move to consolidate global logistics. So how do all these moving parts translate into shareholder value as we look out 5 years to FY 2031? Before we walk through these numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. For context, we are starting from a current share price of $68.18. Let's look at the base case first, which we're assigning a 55% subjective probability. Operationally, this scenario assumes steady execution. The Delivery Hero integration is successful, their high-margin advertising network expands steadily, and AV partnerships scale as planned without entirely disrupting their marketplace. This leads to $110.71 billion in year 5 revenue. With operating leverage, free cash flow margins hit 19%, meaning they're generating over $21 billion in cash. Applying a 20 times exit multiple gives us an implied price of $233.72, which is a fantastic annualized return of nearly 28%. But the extremes are where the operational story gets really interesting. In the low case, representing a 20% probability, the market's biggest fears actually come true. Waymo and other AV developers successfully launch independent networks and bypass Uber. Combine that with regulatory headwinds forcing worker reclassification in key markets and free cash flow margins compressed to just 14%. The market slaps a mature 12 times multiple on the stock, resulting in a year 5 price of $72.79. That's basically dead money, an annualized return of just 1.3%. Conversely, in the high case, which holds a 25% probability, Uber successfully transitions into the undisputed central orchestrator of the global autonomous vehicle market. Autonomous trips scale rapidly, which practically eliminates massive human driver payout costs, causing free cash flow margins to explode to 23%. Paired with massive ad revenue scaling and a premium 25 times multiple, the implied price skyrockets to $444.94. That's an annualized return of over 45%. Again, if you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
Now, the difference between that base case and the low case all comes down to risk. So let's look at the thesis-killing risks that investors absolutely need to monitor closely, because these are the concrete factors that will decide Uber's fate.
First up is the regulatory battle over driver reclassification, particularly over in Europe. If labor authorities force Uber to reclassify independent contractors as employees, it adds 20 to 30% in immediate labor costs. That completely destroys the margin expansion narrative. Second is the AV disintermediation threat we discussed. If Waymo scales independently, it's a huge problem. Early warning signs here would be a drop in monthly active platform consumers as riders start switching to independent AV apps. Third is the delivery hero execution risk. Integrating operations across 50 international markets while adding debt is a massive operational distraction for management. And finally, something rarely talked about: captive insurance risks. Uber self-funds 95% of its insurance risk through a Hawaii-based captive insurer. Those reserves grew 27% year-over-year to $12.46 billion. Critics argue they are over-reserving, meaning setting aside too much money to artificially lower taxable profits, while management uses it as a strategic capital pool. If regulators crack down on this structure, it could lock up billions in capital.
Which brings us right back to where we started. That's 7.2% free cash flow yield. Wall Street is staring at the Waymo threat, the regulatory battles, and the integration risks, and they are pricing the stock as if the low case is almost a certainty. They are pricing in a mature, low-growth business out of fear.
So that is the ultimate tension to resolve our story today. The numbers tell us the core business has literally never been stronger, more profitable, or more dominant. But in this market, current cash flow isn't enough. You have to prove you own the future too. Whether Dara Khosrowshahi can force the AV developers to play by his rules within the Uber ecosystem is the single most important storyline to watch next.
If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. So I'll leave you with this. Is Uber a dying duopoly, destined to be disintermediated by Alphabet and Waymo? Or is it the radically undervalued central orchestrator of the global robotaxi future? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.